Hi, everybody. Brett Mills here with Guild Mortgage. Today, I want to talk about a reverse mortgage. We also call them a flex payment mortgage. I'm going to walk you through education of what it is, what it's not, common myths that you see or hear about. And this is really for everyone's education. Often, a reverse mortgage is looked at as a loan of last resort. I hope by the time we get done today, you're going to see the powerful tool it is to help you in multiple facets in almost any situation through your retirement years. So this may apply to you. Maybe you're in your retirement years. Maybe you got a family member that's in the retirement years and you're trying to get education. Tune in. I'm going to walk you through that today. So first of all, let's talk about what a reverse mortgage is and the requirements there. So the one I'm going to focus on today is what's called a HECM, Home Equity Conversion Mortgage. It's backed by FHA, the Federal Housing Administration, or HUD. There are other ones that we can do, but I want to focus here. So to qualify for a HECM, you need to be 62 years old. One of the borrowers needs to be 62 years old. So there was a change in 2014 that I think was fantastic. That, let's say you're a married couple, only one of the borrowers on the note needs to be 62, and we can proceed with that. Before, you both had to be 62. So with that, what a reverse mortgage does, you can use it for multiple things. You can use it, let's say you already own a home. You can use it to pay off an existing mortgage balance. Let's say the home's paid off. You can set up a line of credit to pull money out when you need it on a tax-free basis because it's equity that you have. You can set it up to where you're drawing a monthly stream of income out to help subsidize your income. And so those are a few of the ways we can use it. You can also use a reverse mortgage to purchase a new home. And so a lot of people may have their homes free and clear, but it doesn't really meet their current needs as they age. Well, we can sell that, take all that equity from the current home, buy another, often even bigger or nicer, more expensive, I should say, home or bigger that accommodates their needs and still not have a mortgage payment. So on a reverse mortgage, it eliminates the need to make the monthly mortgage, the monthly scheduled mortgage payment that is there with a regular forward mortgage, a traditional mortgage of what you would hear about. With the reverse, interest accrues on what the outstanding balance is every month and gets added on top of the amount you owe. And that will continue until the note is called due. So let's talk about what calls the note due. The thing that calls that note due is the last person on the note and deed of trust. That's why it's important that both spouses are on there. Permanently leaves the home for a period of 12 months or more. So the couple things that I most commonly see with that, of course, death of the last person, or two, going into a long-term care facility for a period of 12 months or more. That's going to call that note due. Now, with that reverse mortgage, you are on title. You don't lose the home. The bank doesn't take title to the home. That's a common misconception I get. It's no different than a forward mortgage. So when that note is called due, let's say you decide to sell your house, you just like a regular mortgage to get the payoff on the balance that you had originally borrowed, plus the interest that's accumulated, and you take the difference as your equity. You can put that down on another home, do whatever you want with it. If you passed on, your posterity gets all that equity. So they'll just sell the home, the value minus what's accumulated, and that becomes their equity distributed like you would normally with a normal will and trust. So that's what I typically see call that reverse mortgage due. But once again, you are in the driver's seat. It's not something a lot of people think it's kind of once you do it, there's point of no return. I can never move. Nothing further from the truth. You have title to the property. You are in complete control on that, and the bank never takes title of that unless you default. So if you had violated that requirement of being out of the home permanently for a period of 12 months or more, and at that point, and you didn't do anything about it, then the bank would have to begin to start that foreclosure process just to recoup that and enforce that. So those are some important points on the reverse mortgage. Let's move into perhaps an example on a breakdown. So I want to run you through a scenario that I commonly see. So in our example today, I'm going to use the example that someone owes $150,000 still on their current mortgage, on a forward mortgage. And I'm going to say that payment is currently $1,500 a month. So they got $1,500 going out a month. On the reverse mortgage, the goal here is that we would reverse that to where they don't have a monthly payment. That frees up $18,000 a year in in cash that's not going out and provides them quality of life. Now, the borrower will still continue to pay their own property taxes and homeowners insurance on their own. But the point is that we'd be freeing up that monthly cash flow, which provide liquidity and opportunity. But we're also going to see how it provides them access to additional funds. So I'm going to walk you through an example here. There are different types of reverse mortgages you can do. You can do variable rate or fixed rate. The variable rate is the one we do most often. It gives you access to more money than the fixed rate option. So I'm going to focus on this column to walk you through how that would function. So it's tied to the Treasury. Is what you're going to have is you're going to have what's called a margin that is added to whatever the Treasury rate is that month. And so, for example, Treasury is currently at 3.68. You'd add the margin of 2.25% to that, gives you a total cost of 5.875%. So that would be assessed against the outstanding balance that month, and that would be the interest that's added to the loan balance. The expected rate is just a calculation that we use for determining how much equity you can access. But this one here has a cap on it of 5%, meaning that it can't ever go more than 5% higher than that initial interest rate. So it can never go higher than the 10.875%. Now, with the reverse mortgage, I mentioned that FHA or HUD is involved in these ones that I like. The other ones are called proprietary reverse mortgages, and we can do those as young as 55. And also we can do those on if you have multi-million-dollar homes. That allows us to access more on those types of products. But for our purpose today, the FHA product charges an annual mortgage insurance premium. It's 0.5% of that outstanding balance. So I like to kind of look at it as a cost of interest. Really, it's that 5.875 plus the 0.5% to give us a total cost. In that situation, what would be assessed at the 6.375. Now, this rate will go up and down every month, and that will go change the amount of interest. So let's say that the Treasury dropped to 3% even next month. Well, that would you'd add the margin of 2.25%. That would accumulate interest at the 5.25 for that month. If it went up to 4%, you'd add that 2.25 on, and you'd be at 6 and a quarter, for example. So that will move up and down from month to month. Moving on down here, one of the coolest parts of a reverse or flex payment mortgage is that the equity that you still have available on your line or available in the home after paying that $150,000 mortgage off actually begins to grow at whatever the interest rate is plus 0.5%. And so it actually allows you to gain access to more and more tax-free dollars over time that you can use and pull out of your home. Let's say you need to buy a car, do home improvements down the road. You want to take your entire family on a vacation. There's some myriad of reasons, just quality of life that you could look at. And so you may look at it and say, well, the $1,500 a month, let's say that you want that you're saying cash flow is okay, but I really can't be involved in my grandkids' lives. Like I'd love to be able to have an experience with them or help pay for their college or things that are important to you. We just freed up $18,000 to make a difference in their lives while you're alive. There's a huge opportunity to that you can make a difference while they're alive. And so that's one of the benefits that comes into this. So let's run down through some example on closing costs of how this reverse mortgage works. So what we do, there's an origination fee on the reverse mortgages. Most commonly, we just put this at a set amount of $6,000. There's other reasons we would pull that down. But most commonly, it's about $6,000. That's what would come to Guild. The mortgage insurance premium. So in our example, I'm using a home that's worth $800,000, by the way, here. So I'd say that the person's home is worth $800,000. Based on their age, these guys are 70 in our example. That gives them access to $313,600 on this particular product. So that's money that they can access. So we'd have this backed out of that would be the $6,000 for the origination fee. And then FHA or HUD charges a 2% premium upfront one time that goes into the mutual mortgage insurance premium fund. So that is based on 2% of the home value. So that is one time that goes in. So that looks a little bit of a bigger fee. I'll talk about that in just a minute. The closing costs, that's going to be your title reports, your appraisals, all those different type of third-party fees, estimated about $4,023. So that's the total in cost. Now, if you look at this, man, that's a lot. But when you start to amortize that over time, that you don't have a payment anymore, once again, in this situation, if they just free up $18,000 a month in cash flow that's going out, you've made that back really, really fast in quality of life. And so you've got to be able to see both sides of the coin. So too many people miss out on the big opportunities in life because they're just focused on the cost side of the coin. It is important and relevant to look at that, but what are the opportunities that you're accessing and gaining as an opportunity? So if you're looking at both of them, I think it helps you make a better decision on this as a tool for you. So in this situation, they owe $150,000 on their current mortgage that will now be paid off. And so when you add all that up, that means that we're up to $176,000 that between the fees and the payoff there. And so they have access to $313,000. Well, that's an awesome scenario to have. And so as we start to jump down here, they cap how much you can pull out your first year on these. And so that's going to be that plus this 31,000 you can pull out your first year. So they could pull up to 207,000 out, meaning they could pull $31,000 out in addition to paying the balance off on their mortgage the first year. After the first year, it's one of the provisions of the FHA is they will allow you to access all that other available equity. So you'd have access to that other 106,000 after the first year. And so you can pull that out at any point. Once again, the cool part is that this becomes a fantastic tool that you can use in retirement to be able to access more funds over time in a tax-free basis, supplement your income. But even if you've got money in your retirement plan, let's say that we have a downturn in the stock market. Statistically, the market hasn't taken a steep downturn for more than 18 months. Perhaps you're looking at it saying, you know what, the market's down. So for the next 18 months or 2 years, I'm going to pull money and living expenses off of this line of credit tax-free. And then when the market picks back up and takes back off, I'll just pay that line of credit or the balance down on the reverse mortgage. Because did you know you can make payments on a reverse mortgage? And when you pay that down, interest is no longer accumulating on that outstanding balance. And all that you've paid down increases that available line of credit that is growing over time and giving you more options down the road. So like I say, there's very flexible that you can have lots of options on this. So that's how that would look and create opportunities for a lot more money to be able to get quality of life here. So I'm going to go down and show you a couple of examples that are often misunderstood. This one here is the first one. So I mentioned that they would have access to, let me jump back up there. About $137,000 available on that line of credit after paying off that $150,000 mortgage. So that's still there. So if they don't draw on it right out the future, once again, this continues to grow over time because it's growing at whatever the interest rate is plus 0.5%. So you move down the road really 15 years, and that's estimated to be up to where they could access about $375,000 of tax-free dollars. Incredibly powerful. It gives them another bucket to be able to use in addition to Social Security or retirement funds. You may be looking at different timing of when to draw money out of retirement. Maybe you want to delay taking your Social Security to get a higher amount. This allows you to bridge that gap. Maybe you're wanting to convert cash over in RMDs. There's so many things that you can do with this as a powerful tool to help your assets work harder for you and create more experiences while you're alive. And so that's how that reverse mortgage line of credit would grow over time. Now, if you pulled out, say, 100,000 of it right out the gate, well, then you'd only have 37,000 growing over time unless you paid that back down. So say you got a big inheritance in 10 years or something like that, pay it back down, all that's available. I wouldn't close it. It's an incredible tool. So this one here is addressing one of the common myths. So let's say that you went and borrowed the funds out of it. So we're back up here just to illustrate this. Right out the gate, you took $176,000 to pay off the existing mortgage and roll the closing costs since you're not coming in out of pocket with that. So down here, it's showing you that, well, yes, interest begins to accrue on that. Well, here's the interesting part. So we saw here that this first month, just to illustrate this, that the interest rate was 5.875. So if I take the $176,000 times 0.05875, that means that you would add about $10,340 on top of what you already owe for the next year. So yes, you're going to owe more a year from now. Just assume that the interest rate stayed right there. That'd be $10,340 more that you would owe on that balance. Now, here's the interesting part. Say you have an $800,000 home appreciating at 3%. Well, 3% appreciation on 800,000 is actually an increase of $24,000 in what your home's worth next year. So you went backwards 10,340, but your home went up $24,000. And that's the irony, is most of the time you continue to gain equity over time. Now, if interest rates went up and stayed pegged at 10.875 for 10 years, then it would start to eat into that equity. But most of the time, it is actually continuing to gain equity. So you're looking at that and saying, man, even after 15 years, if you passed away or you decided to sell the home, let's even go to 10 years that you decide, you know what, the home doesn't meet my needs. I want a different location, a different climate, families moved. You sell it and you're walking away with roughly $725,000 there that you can go and put down as a down payment on your next home, do another reverse mortgage and still not have a payment. And so it's an incredibly powerful tool. One of the things I wanted to mention is when this comes due, let's say that the interest rates did go and stayed at 10.875 for 20 years, and you had passed away and your kids got it, and it was, in fact, upside down in a negative equity position. They have two options. One, they can give it back as a foreclosure. And in that situation, the home was the collateral. They're not liable for anything. Or two, they actually have the ability, if there was some nostalgic reason that they wanted to buy the home for 95% of whatever it's worth, they can actually do that and keep the property. If they wanted to keep it as a rental property in any of these situations and there was equity in it, they just do a refinance on a regular mortgage, pay it off, and they can keep the home. So tons of options when you start to look at how cool these reverse mortgage flex payments are, our flex payment mortgages are. So I hope this education is helpful for you. Please share this with anybody that may be thinking about or that may benefit from this type of an analysis. We can dive in and look at your specific situation. There's no charge to run that analysis and see how this might be a tool to help you improve the quality of life through your retirement years. And actually be an ability to provide an additional bucket of funds to help you. So hopefully that's helpful. Brett Mills at Guild Mortgage, happy to talk with anybody and run through one of these examples with their specific scenario. Feel free to call me at 801-614-5125. Once again, 801-614-5125.